the end. I'm now going to bring in David Cornell to talk about India capital growth. We'll start off with, my question went wrong with IGC, but it was doing incredibly well a couple of years ago, but performance more recently hasn't been that good. I know you've been doing some things to tackle that. So do you want to just sort of to give us some background, please, David, about how the fund's been doing, what's been impacting the performance, and what the changes that have been made are?
Sure. Hi, everybody. Thank you, James, for asking me on to this event. And so I think, as you rightly say, IGC performed incredibly strongly immediately post the election of Prime Minister Modi back in 2014, all the way up until kind of mid-2017, late 2017, compounding at around 30% per annum in sterling terms, and comfortably beating its benchmark on a relative basis by around about 17% over that period. Things started to go wrong in late 2017, and there were really three reasons from a macro perspective why mid and small cap equities underperformed and fell in absolute terms. So I'll just touch on those, and then I'll talk a bit about why we've underperformed from a relative perspective, because that's also obviously important. The first point is that late in 17, mid-cap equity valuations had reached a peak both in absolute terms and relative to large caps, around about a 20% premium, I would say, in aggregate. And we took a decision at that point as an investment team to try and mitigate some of that risk in valuations without wanting to be out of the market, particularly to increase the number of stocks in the portfolio, so to reduce the concentration risk, and to make additions in the portfolio further down the market cap curve to move into the smaller sized companies where we saw the potential for more value, given this premium that mid caps are trading on, and a reluctance to buy the large caps because obviously the mandate doesn't allow us to do that materially. But what happened actually was there was a massive rotation out of mid caps and into large caps late 2017 that ran all the way until December 2019. Actually, in keeping with a global trend, I think, to buy very expensive, very high quality kind of growth companies. And in India's case, the concentration of performance in large caps was only limited to 4 or 5 stocks. Everything else went through a very torrid time as the Indian economy was kind of losing a bit of momentum for various reasons, which I can discuss in due course. So that's point number one. I had massive rotation out of the asset class, and mid caps underperformed large caps, and small caps underperformed mid caps. So we were kind of hit two ways, really. Mm-hmm. The second thing was that as a consequence of I guess an unintended consequence of a lot of the structural reforms that Prime Minister Modi has put in place in India, all of which I think are good and will benefit over the long term, it led to a default in the domestic bond markets of a quasi-government lender called IL&FS, who defaulted on its short-term paper. And this led to a massive liquidity squeeze as confidence evaporated in the Indian credit and equity markets. And it had a very real impact on the small and mid-cap area of the market, which, of course, is very dependent on capital markets, and particularly the debt markets, for raising capital in which to grow. Mm-hmm. And that had a severe impact on our portfolio, particularly our financials exposure. We've long had the view that the kind of the financial inclusion, or I would say the sort of the bringing of hundreds of millions of Indians into the financial community through better technology and opening bank accounts is a theme we strongly believe in and still do. But it had had a material impact on our financial exposure because of the liquidity squeeze and the impact it was having on some of our the quality of the asset book and asset books of some of the banks we own. So I guess we had a problem, particularly in financials, but also in consumer stocks as well. It's another strong theme that we've been playing and we continue to believe in most intently in the rural parts of India, where we think incremental consumption in India, in rural India, can be very strong going forward. So, but again, the liquidity squeeze had an impact on consumption, and both our financial stocks and our consumer stocks have been heavily derated from the sort of mid-cap P premiums I was talking about at the back of 17 to where we sit today, which is kind of almost at 15-year lows. So that was the second reason. And the third reason was the kind of onset of COVID beginning of the year, and mid and small cap Indian equities are not necessarily the place you want to be in the first instance when a pandemic hits risk assets. And that's had an impact on absolute returns and on relative performance as well. I want to also make it very clear that those events shouldn't mask the fact that we've had some stock picking mistakes in the portfolio, particularly moving down from the mid caps to the smaller caps, where corporate governance issues are greater, where it's harder to sort of get enough information on the companies and to get confidence in the companies, and we have made mistakes there, and those stock picking mistakes have led to the underperformance. And as you will know, and many of your listeners will also know, I'm sure, that it's very often just one or two stocks in a portfolio that does the damage. I guess the other point I should make, if I'm being completely honest with you, is that there was a reluctance. There has been a reluctance in the investment team, I think, to react to some of those macro events that I was referring to. And we tend to have very long holding periods for stocks, and we've been sitting on stocks that haven't been working because they're beginning cheaper, and that's caused a kind of drag on performance as well. So,
okay, it might be useful just to explain to the people listening how the management of the portfolio works, because you're based in London, but there's a team in India as well, isn't there?
Yeah, that's right. So the team in India are responsible for the construction of portfolios and for doing all the equity research into our investee companies. So there's a team of 2 portfolio managers, Trilid Pathak and Gaurav Narayan, and then 5 analysts, sector analysts, who support them on both India Capital Growth and on our open-ended fund. And then as the CIO sitting in London, I act as the overall kind of risk manager, I would say, and all the trading is done from London. So the team in India effectively advise me as a CIO on what they want to do and when they want to do it. But we don't in London get involved with the day-to-day running of the portfolios. That is, the team in Bombay is fully empowered to do that.
Okay, cool. So, but the upshot of all of that is obviously the performance hasn't been matching the benchmark, and so the board has decided that it was going to trigger a continuation vote, and they're going to bring that forward. So you've taken a number of measures, I think, to try and put things on a surer footing for the future. Do you want to sort of run through what they are?
Yeah, certainly. There are 3, actually, and I should point out that this has been a work in progress for about 7 or 8 months now. Mm-hmm. The performance has been poor for 3 years, but actually the breakdown really happened in the last 12 months. And we've been taking some quite meaningful steps to address these issues. The first has been to strengthen the investment team, and we've appointed a co-head of equities alongside Gaurav, who is responsible for stock selection in the investment trust. We appointed a co-head to work alongside him with 30 years experience with Indian equity markets, and then 2 additional analysts in support, 1 senior and 1 junior. So we've got 5 analysts now supporting 2 portfolio managers, a stronger, more experienced and more settled team, which is important. The second thing we've done is to close our Emerging India Fund, which was to some extent a competing fund to IGC. Gaurav was running both, or was responsible for stock selection in both. And I think that was causing some issues. And the Emerging India Fund wasn't growing, and it was not only absorbing a lot of his time, but also it was unclear, I think, in how those two could sit next to each other. So we've closed that, and his focus is now back on IGC, on the investment trust, 100% of the time, which is already starting to make a difference, because his kind of bandwidth, you could say, is fully apportioned. We've made some quite big moves to tighten up the process because of this sort of small cap drift I referred to earlier. The team's now working off an investable universe of 140 stocks, which are all pre-approved through an investment committee process, a qualitative and quantitative screening process. And the investment managers can only pick from this list now. So they are picking from a list that has already been through quite a rigorous screening process. And that, to some extent, restricts their ability to sort of deviate from a chosen path. The added benefit of the universe is also that the analysts that maintain the stocks have a much more focused approach, because now they cover 30 stocks each, and 30 stocks only, and they live and breathe those stocks 24/7, and it helps, build conviction and through depth and knowledge of understanding. And I think previously we were running around chasing all the new ideas and looking for value in all sorts of strange places that wasn't working. So this is a much more focused approach. And I think the final point about the universe is it's helping us to integrate what we call our non-financial analysis to small and mid-cap companies in India. From an ESG perspective, it's very important that we understand how the corporates are addressing a lot of these concerns, and we think as bottom-up stock selectors, we have a lot of value to add in that regard, in terms of our understanding of how they approach it, not in terms of how we can help them, but how we understand what they're doing and what that means for performance going forward. So those are the things that we've done. We've added quite a lot of artificial intelligence software to our process to try and improve analyst productivity. Aggregation of unstructured data through AI is really helping in terms of bringing down the time it takes to sort through all the information that's required, and that's quite positive. And we've also put a ranking tool together that helps the fund managers understand how their stocks are valued relative to others in the universe.
Cool. Okay. So actually, has that meant many changes in the portfolio?
Yeah, it has actually. Historically, as you know, turnover has been very low. That's picked up substantially. Not substantially. We're now at about 25% turnover rather than 12% turnover. So doubled off a low base. But 15% of the portfolio is new, 5 new stocks. None of them are private sector banks or consumer-facing companies, so fresh ideas. A general insurance company we bought, which is doing very well. The COVID sort of scenario is helping to drive demand for general insurance and health insurance. We bought some gas-related companies as India's economy gasifies in an attempt to become cleaner, both logistics and domestic gas use. We bought India's largest commodity exchange, which is benefiting from volatility in the short term, but also from a kind of networking effect along the lines of other stock exchanges globally. So yeah, some new ideas, and what's more, they're actually working. The outperformance that the aggregated component of new ideas in the portfolio is starting to generate some positive returns. So we're very excited about that.
Cool. Okay, good. We should talk about COVID-19. I think specifically what's going on in India with respect to that. Yeah. It's
a tough one, isn't it? Very quickly, India, in terms of its approach to COVID, prioritised health over economics, as you would expect. has put in place what is considered globally to be the most stringent of all lockdowns, which went in place on the 25th of March with very little notice and caused a lot of short-term disruption to people's lives, particularly migrant workers who were stuck in the cities who couldn't get home, and there was a lot of kind of media coverage about the way in which the government in India handled that. The government has, I mean, the pandemic has not spread in India as had previously been expected. And if you look at the proportion of people being tested that have been tested positive, it's very low relative to other countries. And actually, if you look at the number of districts in India that have suffered, it's also quite low. The rural areas have been relatively immune. The urban areas less so. The economic impact's very hard to gauge right now, but you know, along the lines of every other country globally, you know, this year's earnings are write-off, next year's earnings possibly a write-off. You know, we're trying to figure that out. What I can tell you, anecdotally, because we talked to a lot of people on the ground in lots of different parts of the country, you know, are the hospitals full? No. Are the chemists running out of drugs? No. Are there people visibly suffering on the streets from COVID? No. You know, so there's a lot of skepticism about the data coming out of the government, but the you know, the on-the-ground, bottom-up sort of feedback from all sorts of different people in different parts of India is that the thing is being relatively well contained. So, you know, whether that's because they're a few weeks behind us or not, I don't know.
Cool. Okay, that's encouraging. So, assuming shareholders now vote for continuation, what are they going to get? So, you've had a bit of a jump in the share price since all the stuff's been announced. I think it was I think, on 34, 35 discount, and now it's what, about 21?
Yeah, the market's been going up a little bit as well, James. So the discount, to some extent, the discount's staying wide despite the NAV going up.
Cool. So what is the sort of upside for shareholders, and what measures have you taken that will help them give them peace of mind? Yeah.
So I think what we're arguing is that the valuations in India, particularly in mid-caps, are at 15-year lows. It's not a good time to be forcing liquidation, despite the poor performance that the manager has delivered in the last 3 years. And that the combination of, you know, a turnaround in investment performance on the back of the changes that I've highlighted, combined with a cyclical recovery in India's economy, which we believe is long overdue and was you know, starting to appear prior to COVID, combined with a kind of reversal of this large cap, mid cap underperformance, which has been going on for 3 years. You know, those three things could all be very positive for the NAV. And that, combined with the steps that the board has taken to ensure that the share price trades more closely to the NAV, by giving investors a guarantee that they can get their money out at close to par in 18 months' time, you know, the combination of those things should far outweigh any short-term upside that investors might be tempted to take by voting for liquidation. So, you know, mean reversion of the discount, mean reversion of performance, mean reversion of mid over large, combined with an economic recovery in India, could actually be very punchy for the share price.
Cool. Okay. Good. Well, I think we should probably ask some questions now. Let's just see what we've got on the Q&A stuff. So one of the questions here, I think, is just really what's the catalyst for a rebound in the Indian stock market. So if you set aside COVID for the minute, what were people looking for? Right, because it was, yeah. What's going to be the catalyst to make it go back up again?
I mean, the government's being quite proactive in terms of injecting liquidity into the economy in India, as has been the case all over the world. India is a big beneficiary of lower oil prices, huge beneficiary of lower oil prices, and that's to some extent an additional injection of monetary stimulus as the economy benefits from buying oil at half the price it was a year ago. So I think those are kind of very short-term aspects. I mean, proactive monetary response, a fiscal response from India, albeit not huge, because they don't have a lot of fiscal flexibility. And I'm glad that they're not using that particular tool. I actually think the most important thing will be a sort of re-energizing of the structural reforms around land and around labour that can unleash a lot of productivity improvements in India that have stalled. And you know, a lot of people in India are talking about this being a 1990, 1991 moment, which some of your listeners may recall when Manmohan Singh, as the finance minister in India, went on the back foot economically, was forced to open up the economy, and it was a kind of launch pad for 20 years of rising growth in India and very strong stock market performance. We think that, you know, with his back against the wall, Mr. Modi is talking about a lot of structural reform again, particularly taking advantage of some of the supply chain disruption fears that exist around China at the moment, and whether India can position itself as a reliable alternative option. And if they can capture that, any small part of that market share, then I think the economy's got a lot of potential. And the other point, I think, finally, is that, you know, a lot of the good work's been done. You know, Mr. Modi has made a lot of structural changes that have had a short-term negative impact on growth. When they start to benefit, you know, it could be very strong. Could be very strong.
Oh, okay. Are you going to change what you invest in? Are you going to invest in more large caps?
No, we're not. We're not. We have a mandate to invest in small and mid-cap funds, small and mid-cap equities in India. We see much more value. And we have a much more active. I mean, we're an active manager. We like, it's a selection of our best ideas, and we think, you know, large caps, you can buy a tracker for those. This should give you a real active management, and we think that the domestic engine room of India, which is what investors generally want when they buy exposure to India, is, you know, comes in the smaller mid caps market, unquestionably.
Okay, cool. Yeah, this question about politics. So, I suppose the general question is, to what extent are the sort of government reforms hindering or encouraging the growth of India? Because they've seen quite a few things happen recently with goods and services tax, things like that, and the response has been that Indian growth has slowed. So, are they long-term benefits still? These things?
Yeah, they are. I mean, I think we probably, I think the implementation of some of these reforms has been badly handled. Demonetization is one, which is very controversial. Goods and services tax, another, which has been tough to implement, and a lot of people kind of, you know, struggling to get on the platform, and you know, the Insolvency and Bankruptcy Act, although very positive because it takes control back from the borrower and gives it back to the lender, has had a, you know, impact on asset quality. All these things are hugely productive for the Indian economy. There's a lot of conflicted interest, don't forget. You know, we're moving away from a sort of patronage-based system based on bribery and corruption to a rules-based system. And there's a lot of people who stand to lose a lot as the country progresses. And so the implementation is fraught. And I think the Prime Minister and his team are doing a very good job, but it takes a lot of time. And what happens is, as we saw in June 14 to June 17, when the market did very well, the market's very excited about it. And then when it doesn't come through as fast as people were expecting, they get very depressed about it. And the glass goes from being half full to being half empty. Now we're half empty again. The reality is that there's a lot changing, and it's all very positive. And it won't be long before the glass is half full again.
Cool. Okay. Good. All right. I think we can probably leave it there. And because I know that you've got another webinar planned for 12 o'clock, so I should probably let you go and prepare for that one. So there are 2 webinars set up for David to talk through the board's decision and proposals for the future. And there's much more information about them on the QuotedData website. Which, if you look at the events section, is actually the first thing there, India Capital Growth webinar. So there's one today at noon and one on the 3rd of June at noon. So go and check those out. And actually, we published a research note recently on this as well. So by all means, go and have a look at that. So thanks very much for that, David. All very interesting. And good luck with the future. Next week, we're talking to Scottish Mortgage. So I'll talk to you all then. Thanks. Bye-bye.